Hey, welcome back to The Dive. Today on the show, we have Craig Hemke from TF Metals Report. Craig is going to share his thoughts on what's happening in the UK, September CPI, the Fed's strategy, when he thinks a rate cut could take place, diesel prices, and of course, the precious metals. But before we bring you Craig's interview, do me one quick favor and just go ahead and subscribe to our channel below me there by hitting that red subscribe button. Hey, Craig, welcome back to The Dive.
Hi, Cassandra. Always good to see you.
Yeah, it's great to have you back on here. Okay, so a lot is happening in the UK, so let's start our conversation out there. Prime Minister Liz Truss has reversed a plan to scrap the top rate of income tax, and she's also fired her finance minister. What are your thoughts on what's going on in the UK?
Finance minister is a job that is a pretty short-term job. I think I saw on Twitter, it's like they're going on their fifth one now in the last several years. That's not a job with much longevity, it seems. I don't know. To me, it's just a small example of what's coming. The Bank of England was trying to hike rates, and in doing so, forced their bond market, which they call them gilts over there, into just almost a total meltdown. And after a decade or a decade plus of negative interest rates and zero interest rates, the pension plans in England had completely levered themselves up to where they had extreme exposure if rates went up. And that's exactly what happened. And so to create some kind of market and price stability, the Bank of England had to come in and start monetizing and buying government bonds again. And that's just a small, like I said, a small example of what's going to happen everywhere. It's just a matter of time. I think it's silly that people think that somehow Powell is Volcker and that the Fed is just going to hike rates, to some extreme level. No, they'll hike until something breaks. Something began to break in England, and you saw what happened. And eventually that's going to happen in the US as well. That, if given the choice between economic collapse and market collapse or just the perpetuation of the Ponzi, the Fed has shown for 15 years that they're always going to side with the banks and the perpetuation of the Ponzi. I'm sure they will again.
Now, what is your take on the strength in the US dollar and what should we be following?
Well, again, I always want to advise people, if you see on the nightly news or on CNN or whatever that they say the dollar is strong, they're always comparing it to the other fiat currency in the world. Because the main way that the dollar is measured is through the dollar index. And that is a basket of other paper currencies, primarily the euro, which is like 57 or 58% weighted in the index, but also the yen and the yuan and the pound, and you could go down the list. So when the dollar is going up, it's because those other ones are weak. And when the dollar goes down, the other ones are perceived to be strong, but they're all devaluing. It's just at the current time, the dollar is devaluing at a slower rate than those other paper currencies. And so it's perceived as being strong. That'll turn, that'll change again at some point in the future. But for now, that's what the trend is. And that's what's hitting all risk assets, if you will, stocks, commodities, gold, silver, the rest. The dollar, though, it keeps going higher. And so until that trend breaks, that dollar index trend breaks and starts heading downward, we're probably going to continue to suffer as a consequence.
Now, September CPI came in at 8.3%, and the markets are pricing in a 98% chance of another 75 basis point hike at the November 2nd meeting. What is your read on the Fed's current strategy?
Well, the last meeting, which is now 4 weeks ago, because the next one is 2 weeks away, that's what they told us they were going to do. I mean, they said they were going to hike 75 basis points in November, another 50 basis points in December, and then see what happens after that. So they're only following along with what they said they were going to do a month ago, and nothing has changed. What's funny is they run out these Fed goons, with 20 different speeches from 20 different goons over the course of a week to all say the same thing, and the market reacts as if it's some kind of new news. But that's what they're going to do. We'll just have to deal with it. Like I said, what hasn't happened so far in the US is what just took place in the UK, where something begins to break. I mean, the corporate bond market seems to be in kind of liquidation mode. High yield bonds are in kind of a in liquidation mode. Those, if you measure them by their ETFs, are some of the lowest levels we've seen in over a decade. But again, nothing has seized up just yet to create panic in the Fed and force a reversal. So we'll just continue to ride it out, I guess. There's not a whole lot more we can do. But I know that in the end, the Fed will be forced to pivot and start cutting rates again. And they're so backward looking, Cassandra. It gets very, very frustrating. We're talking about people at the Fed who most of them have never had a job outside of the Fed. They're just mainly ivory tower academics that work in this theoretical world. And they look at the US and presume somehow that the economy is strong and that they can keep on hiking when they're hiking into a faltering economy, a slowing job market, everything else. So they're going to make things worse than they would have otherwise, just like inflation got worse because they were so slow to act last year. But now they're hiking while the economy is faltering, and they're going to make the stagflationary recession that much worse. But no one's nominating me or you or anybody else to be the head of the Fed. So we're just kind of stuck with whatever hand they deal us.
When do you think the first sign of a rate cut will be priced in?
Starting to see, the Fed funds futures and things like that are pricing in something about the end of the first quarter, like March, maybe, or maybe a little bit later. I would like to think the dollar and then by extension, the precious metals would begin to anticipate that maybe by the end of the year. I mean, I thought when I wrote my forecast for this year back in January, it was in anticipation of all this, that the stock market would fall 20%. And just like it did in the fourth quarter of 18, the Fed would panic and start to pivot. Well, the stock market has fallen 20%. And they haven't panicked yet. But they will. I mean, we're just going to have to wait. It's just taking 6 months longer than I thought. But they will. I just have no doubt in my mind that that's the course they'll take again, because they want to keep the plate spinning as long as possible. They're not. I don't think that they're driving us into a total crash. Now, some people think they are driving us into a total crash and collapse, so we can have this, this big reset. But I think they'll hold that off as long as possible so they can hold their power, and enrich themselves as long as possible. And so that pivot is coming. And when it does, the precious metals and the mining shares will soar again. But apparently we're just not there yet.
Okay. Now, how closely are you following what's happening with Credit Suisse?
This is something we've talked about for, I don't know, since 2009 or 10. It comes up every couple of years, and that's the fragility of the EU banking system, because they're all kind of daisy-chained, linked together, where Credit Suisse owns Deutsche Bank's debt, and Deutsche Bank owns UBS's debt, and UBS owns Credit Suisse, Credit Suisse's debt. And the whole thing is looped together. And so you just wait for one domino to start knocking them all down. It's clearly a problem, as is shown by their credit default swaps, by the value of Credit Suisse stock, Deutsche Bank too. And so this is a big challenge for this time, not the UK and the Bank of England, but the EU and the ECB, because really the only policy the ECB has is just to monetize debt and create more euros. Geez, what do we have? 30% producer price inflation in Germany. I mean, inflation is just terrible in Europe, and we're heading off the cliff into this really cold, dangerous winter there. With the current energy situation, everything else. So it's just a complete mess. And again, you get back to it in large part due because the Fed drove rates to zero, printed $5 trillion and added all that to their balance sheet. Just a year ago, goons like Cash Carry were talking about no rate hikes until 2023. And now just a year later, they're talking about, pedal to the metal, now no rate cuts until 2020. These people have no idea what they're doing. And they act in a reactionary measure. They never are proactive. They're always reactive. And they're just driving all of this into this massive mess. And it may start with Credit Suisse. It may not. But again, it seems the policy is just to keep on going until they can't go any further, and just deal with it as it comes. And it seems terribly irresponsible, but it is what it is.
Okay. Now let's shift gears a little bit here. We've
Okay.
seen diesel prices soar in Europe and the US.
Yeah.
Some say that diesel is still the tightest part of the market.
Mm-hmm.
What is your take on its recent price movement?
No doubt about it. You know, you take a molecule of crude oil, the hydrocarbon, and you can only break it once. So when it's getting refined, it's going to be turned into jet fuel or diesel fuel or gasoline or kerosene or any one of the number of things. And so if you're going to make more gasoline to get gasoline prices down, I mean, by extension, you're making less diesel. And diesel prices and the spreads in diesel in either on NYMEX in New York or in Europe are blowing out really wide. And this is a real big problem. Again, part of the problem heading into not only the US and Canadian winter, but particularly the European winter. Last year at this time, it was looking pretty dicey and natural gas prices were spiking. And I remember writing about and calling it, the cold, hard, deadly, and dangerous winter ahead. And dangerous was due to my anticipation from following the Ukraine situation since 2014, that eventually that was probably going to bubble up. I didn't know that Russia was going to invade, but I knew that the European politicians would blame the high gas prices, not on their policies, but on somebody. And Russia was always going to be a boogeyman. Well, everything that's happened since. Well, what are they going to do this time? Who are they going to blame it on this time? Because it's going to be really cold and really dark. And there's a lot of potential societal unrest coming in Europe in particular. And I'll be curious to see how the powers that be try to manage that. But the diesel price, factor that one in. I mean, how's that going to impact food delivery? If you can't drive trucks even because of a diesel shortage, it's just a mess, Cassandra. It's just a mess.
Yeah, scary. Okay, so let's come back and talk about the precious metals.
Okay.
You recently wrote an article for Sprott Money about the widening gap between silver's future price and the physical price. What are the factors that have caused the gap? Could you give us some color on this?
Well, it's like American Eagles are not being produced by the U.S. Mint at present. So there's a scarcity of them. And so you can see the spot price, which gets wagged, is the tail that gets wagged around by the futures price. And you can see that spot price at $19. But you can't, you go on some of these dealers these days, you can't find American Eagles and some other sovereign coins for less than 30 or 35. So you get this kind of bifurcation between what you're told is the price that's derived by the trading of the futures contracts and what you actually pay if you want to get your hand on physical metal. This has happened before. And usually, because that bifurcation draws attention to the scam of this pricing scheme, the price somehow comes back and meets in the middle. As recently as March of 2020, the futures market, in just a liquidation event, because people, hedge funds and everybody were just selling anything that wasn't nailed down to raise cash in March of 2020, COMEX silver futures went to like 12 for just a few days. But you couldn't buy physical metal at 12. It was 24, 26, 28 at the dealers. You can't have that and still claim that your pricing scheme is legitimate. So they eventually came and met in the middle in the high 20s, in the high teens. And then, the price then moved up, once the Fed was doing QE and all that kind of stuff. Same thing will happen again. You just can't keep driving the paper price lower and have it exposed by, the fallacy of that when you can't buy physical metal for, even just generic rounds and bars have a $5 and $6 premium at this point. So that spread will narrow at some point. Either the physical price will come down or the spot price will come up or both or whatever. The curious thing at this point is what is a clear shortage and drain of physical metal. Now, it's not at crisis levels yet, but 5% of the LBMA vaults or put it this way, LBMA vaults fell by 5% in September, continuing a trend. The COMEX vaults are seeing metal flow out. Again, not back down to levels that it was in 2016, but still it's a consistent trend. We're seeing huge a continuous backwardation where the COMEX futures price is 7, 8, 10, 12 cents below the spot price. And that's indicative of heavy, heavy paper shorting, this time coming from the hedge funds that just keep getting short and short, and then they get squeezed and they get short and short again. So anyway, it's all a sign. I take it as a sign that the price of silver probably won't go much lower. I could be dead wrong and get another liquidation events, but I'm not sure it'll go a whole lot lower from here.
Okay. Yeah, we've seen you've been calling the silver bottom, so I was just going to ask if you thought we were there yet, but not yet.
Yeah, and the chart of gold, it still doesn't look like you can say it's bottomed yet. And it's not getting any help. I mean, crude keeps going down, copper keeps going down, the stock market keeps going down because everything's traded by computer, and the computers all see the dollar going up and interest rates going up, and so they just keep selling everything that's perceived as being a risk asset. Silver, on the other hand, yeah, it's down here at 1850 or whatever, but it was 1850 3 months ago. So it's actually been kind of stable, not at a price anybody would want. I mean, we're down 20 some odd % on the year, but it appears to have kind of stabilized here, maybe found a bottom, and that dichotomy and that physical demand probably helping that. The banks, if you watch the commitment of Treasury report, the bank trading desks are actually long COMEX silver, so that probably provides a bit of a floor too. So silver led everything down when everything started breaking down. Everything started breaking down in April. Silver kind of fell farther and faster than stocks or the miners or gold. So maybe the fact that silver seems to be stabilizing is kind of a good sign for everything else as we go into the fourth quarter. And so if we can see silver start moving up, maybe get above 21, that might be a real good sign that the low is in for gold too. But we're not quite at that level yet.
Yeah, the gold price ended last week nearly $90 from its October highs. What is your read on gold's price action? Has your view on gold changed at all?
No, I mean, Cassandra, the chart just looks terrible. If you pull up a yearly chart, there's a clear downtrend that the points all connect on. So it's clearly trending lower with lower highs and lower lows and lower highs, and lower lows. And that hasn't been broken yet. Now, silver, it has been broken. And like I said, it's trying to stabilize. But we don't see that yet in gold. And again, you're still subject to this liquidation type event where, if the world is short of dollars, which it appears to be, and that means you start selling stocks and bonds and commodities and everything else, then who's to say gold can't go below 1,600? But again, at some point, something will break and the Fed will be forced to play catch up, and no one else is buying treasuries. So they're prepared for rates to go to 10%. At some point, they're going to have to start being the buyer of last resort again. The next QE plan will be bigger than the last one because that's how it's worked since 2009. And when that happens, we'll have another bull market surge in the precious metals. Now, whether that will end and everything will just come cascading down again, we'll see. Maybe people will figure out this time after 4 or 5 of these Fed pivots that, wait a second, they're conning us with this stuff about, a return to normalization of interest rates in the balance sheet. But that pivot is coming again. There's no doubt in my mind. It's just, in the meantime, we sit here and, twiddle your thumbs and look out the window and find something interesting to write and talk about every day because all we can really do is wait at this point.
All right. Well, Craig, that's all we have for you today. So thank you so much for coming on and sharing your insights with us.
Well, thanks for asking. It's always good to see you, Cassandra. And we'll talk again soon, I suppose, and we'll see if things have changed by the next time we visit.
Well, thank you so much for tuning in today. We'll be back again tomorrow with the latest news and updates. So be sure to stay tuned by hitting that notification bell before you leave and subscribing below. Thanks and goodbye.